Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So here's an example. Let's say that let's say I wanted to sell a call. All right. So selling a call is bearish if that was the only thing you were doing. So if we sold a call, and I'm just going to use a strike. Let's say the at-the-money strike price. So the 90 strike price. Right now, I quoted this just before I got online, and it was 123 a share. So if we were to sell that call, we'd get paid $1.23 a share, or $123 a contract. You know, I'm ignoring commissions and such, but that was the bid price at the time. This is just, I don't know, 45 minutes ago, an hour ago, something like that. And what this means is that as long as the market by March's expiration closes below 90, I get to keep that entire premium. But what if I want to so that's one way in which I could start to run through my alternatives. All right, so I could sell a call, but if you short an option, you have theoretically unlimited upside, and maybe that's just too much. I don't want to deal with unlimited upside, so I could cover that position and turn this into a vertical if I want by buying a call with a strike price above, and therefore a cheaper premium that's going to limit my risk. So this is going to cost me, so if I bought a call, let's see, at 92.50, so a little further out of the money, so it's going to be a cheaper premium. At the time I was looking at this just an hour ago or so, it was $40 or 40 cents a share, or $40 a contract. So now I have a spread that's a credit spread, credit vertical spread here. It's pretty simple. It's a really basic strategy. Most option traders are familiar with this kind of point of view. I know my upside is limited to the premium, the net premium that I'm going to receive, which is what, about 80 cents or so, or $80 a contract, $80 a spread. But what I got for giving up some of the upside, so for giving up some of that premium, the 123, I know what my maximum loss is, which would be the distance between these two strike prices, 250 minus the premium that I was paid. So if I'm pretty confident that the market is likely to decline, then this is one way that I could approach it. Alternatively, I know a lot of traders do tend to try to keep things pretty simple, and they may even look for just to try to justify an outright long position. So a long put with a strike price of 90 right now would cost about, let's see, I wrote it down, 94 cents. So about an hour ago, it was 94 cents a share, $94 a contract. And we start to think, now, this is a good example, because let's say that was the strategy that you favored. It was just an outright, really simple. I mean, this is really simple. Just buy put. So you got a lot of time value wrapped up in there. That's a problem, but potentially not, because you've made this estimate that you think the prices are likely to get to 86.40, and you get 25 days to expiration. So how far through that distance is it likely to go? You have a $90 strike price. So as long as it gets down below 89 by expiration, let's draw a little line here. As long as you're below 89 by expiration, then you have the potential for a profit. So anywhere 89 or below, you've got the potential for profit. And the advantage with a long option trade is that you've got theoretically unlimited upside. So if you get a really big breakaway like we got through December, say, this was a fairly large and fast break, then you could wind up making quite a bit as a percentage of what you invested. All of this, of course, both the analysis of our little vertical spread up here, as well as our short analysis of just an outright long position, is kind of contingent on us being able to look and make an estimate as to how far is the market likely to go. So we're essentially just using a technical tool to make an initial estimate for that's had some historical success at being able to do this kind of thing. as to where do we think the market is likely to go, and then we can start to evaluate our option alternatives at that point. So if the distance is quite far and we're willing to buy a little bit of time, then an outright long position may offer some more attractive opportunities. Alternatively, if we've got a short-term time horizon or not very far at all, or we are a little less confident that there's going to be a bigger decline, then we may opt for a credit position, something that's going to time value would work in our favor, and we're not as dependent on a big move in the market. But all of this, again, we're kind of basing this analysis on, can we approach the market intelligently and make a rational estimate for where we think prices might go? And this is one of those ways in which we can create those estimates. Now, so that's what I wanted to be able to cover today, and I'd like to get to some questions, and I've got a couple that are building up already. So I want to get to those here in a second. So if you've got questions, go ahead and chime in. But I would say personally, this is a strategy that I use a lot. So this is something that I use all the time, and it's served me pretty well. So I can put a personal recommendation that it's, the advantages of, if you're a technician, the advantages of using this kind of analysis is pretty good, because it gives you a nice basis to try to make decisions about not just where you think the market may or may not go, but what kind of strategy fits that estimate, so that you're not always, kind of flying blind and trying to make your estimates fit the strategy you like. Okay, so let me answer a couple of questions here. I did get a question as to why are some candles filled and some are empty. So the ones that are filled are, let's see, how can I'm going to actually open up a chart. There's a lot of gaps in the way that I'm going to bring up a stock chart actually, just to answer that question, because this is a really common way that that stock charts will display the information. So a red candle that's filled, it means that the open is above the close. So you can see here on Google, for example, the open was at 564 and the close is at 550. So that's going to be a solid red candle. Versus the hollow red candles means that the close is above the open, but still below the prior close. Okay, so in the FX options, you will get a lot of, because there's a lot of movement in the Forex market overnight, so you get a lot of these hollow candles. But that's what that designates. So, and with the green candles, as you can see here, it's a solid green candle because the close was below the open, but it was still higher than the prior close. And a hollow one would be just the reverse. So it's just one of those ways you designate, well, it may have been an up day, but it closed below its open, so kind of gapped up at the open and then closed down lower. So it helps you visualize that. And not all charting packages display it the same way. By the way, one of the questions I get quite a bit are, where can I find, charting packages with Fibonacci and tools? And there's a lot of places. I'm using Metastock in this case, which is a paid product, but I know there's freestockcharts.com. There's Profit.net. There's a lot of options brokers. You may want to look and see what kind of charting do they offer, because a lot of the brokers that really specialize in option trading, they have fairly robust charting packages, and that would include Fibonacci analysis. Usually they have a little help file to tell you where to find it and things like that.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.